By the Economic Club of New York. He spoke about the U.S. economic outlook. This is just over an hour.
Good evening, ladies and gentlemen. Good evening, ladies and gentlemen, and welcome to the 370th meeting in the 95th year of the Economic Club of New York. As chairman of your club, it is my honor and privilege to present this evening's most distinguished guest speaker, the Honorable Alan Greenspan, chairman of the Board of Governors of the Federal Reserve System. A seventh appearance, a true record in the history of this club. Mr. Chairman, we are truly honored and privileged to have you back. Over the course of the 15 years that Alan Greenspan has extraordinarily led the Fed, we have seen his calming influence on our economy. We've seen him meet so many challenges that it is safe to say no one in the history of the agency has seen more, done more, and meant so much to the success of this great economy of ours as Alan Greenspan. We've witnessed the longest peacetime expansion in our nation's history, the true emergence of a global economy with standards of living rising in this country for all Americans, and of course the interdependence of global economies with America at its very center. It has been the calm and extraordinarily talented hand of Alan Greenspan that has guided our nation, our economy, our financial markets, and certainly those who follow us from around the world to success beyond anyone's expectation. A native New Yorker, the chairman earned his undergraduate, master's, and doctoral degrees from New York University. Serving as Fed chairman, initially appointed by President Ronald Reagan, serving under George H.W. Bush, Bill Clinton, and now George W. Bush. He wasn't but 2 months in office back in 1987 when Chairman Greenspan guided our nation's monetary policy through perhaps the most tumultuous period in the history of our markets. A one-day 23% decline in equity prices on the 19th of October, 1987. Chairman Greenspan did what perhaps should have been done after the crash in 1929. He made certain liquidity was in our system, and we avoided tumbling into the depths of economic depression as we did in the 1930s. When one looks back at the leadership years of Alan Greenspan, it is truly an extraordinary number of challenges, crises, and opportunities to change and reshape our economy. Just think, in those 15 years, the reunification of Germany, the dissolution of the Soviet bloc, the Asian financial crisis, the Mexican peso crisis, the Russian debt default, long-term capital management, and of course the greatest challenge to the liquidity and smooth functioning of markets our nation has seen, recovering from the terrorist attack of September the 11th, 2001. We have been blessed in this great nation to have this extraordinary leader. His list of accomplishments are so long, but I know he is most proud of the fact that throughout his tenure, he has kept inflation from creeping back into this economy and ravaging our economic performance. GDP, real GDP, has doubled in his tenure. We've seen the Dow increase fourfold. We've seen volume on the small market that I'm privileged to head more than grow 8 times. We've seen doubling of the households in America who own a share of American business. He truly deserves praise and recognition for 15 years of extraordinary leadership to our nation. And of course, he's recognized around the world, as evidenced by earlier this year being named an honorary Knight Commander of the British Empire. And although, Mr. Chairman, we're not allowed to call you Sir Alan, those of us in my business call you whatever you would like us to call you. Ladies and gentlemen, it is my honor and privilege to introduce for his 7th appearance, the 13th, and in my estimation, finest chairman in the history of the Federal Reserve, the Honorable Alan Greenspan.
Thank you very much. Dick, I was more than willing to have you just stand up here and continue. I was enjoying it immensely. I have a number of interesting subjects I want to discuss this evening, so let me get started, and I look forward to the usual barrage of questions which come at you at this podium, which is going to be exceptionally interesting this evening since, having got up at 5:30 this morning, I haven't a clue what I'm going to say. In the question period, that is. Although the gold standard could hardly be portrayed as having produced a period of price tranquility, it was the case that the price level in 1929 was not much different on net from what it had been in 1800. But in the 2 decades following the abandonment of the gold standard in 1933, the consumer price index in the United States nearly doubled. And in the 4 decades after that, prices quintupled. Monetary policy unleashed from the constraint of domestic gold convertibility had allowed a persistent overissuance of money. As recently as a decade ago, central bankers, having witnessed more than a half-century of chronic inflation, appeared to confirm that a fiat currency was inherently subject to excess. But the adverse consequences of excessive money growth for financial stability and economic performance provoked a backlash. Central banks were finally pressed to rein in overissuance of money, even at the cost of considerable temporary economic disruption. By 1979, the need for drastic measures had become painfully evident here in the United States. The Federal Reserve, under the leadership of Paul Volcker and with the support of both the Carter and the Reagan administrations, dramatically slowed the growth of money. Initially, the economy fell into recession and inflation receded. However, most important, when activity staged a vigorous recovery, the progress made in reducing inflation was largely preserved. By the end of the 1980s, the inflation climate was being altered dramatically. The record of the past 20 years appears to underscore the observation that although pressures for excess issuance of fiat money are chronic, a prudent monetary policy maintained over a protracted period can contain the forces of inflation. With the story of most major economies in the post-war period being the emergence of and then the battle against inflation, concerns about deflation, one of the banes of an earlier century, seldom surfaced. The recent experience of Japan has certainly refocused attention on the possibility that an unanticipated fall in the general price level would convert the otherwise relatively manageable level of nominal debt held by households and businesses into a corrosive rising level of real debt and real debt service costs. It now appears that we have learned that deflation as well as inflation are in the long run monetary phenomena, to extend Milton Friedman's famous dictum. To be sure, in the short to medium run, many forces are at play that complicate the link between money and prices. The widening globalization of market economies in recent years, for example, is integrating a growing share of previously local capacity into an operationally meaningful world total. That process has, at least for a time, brought substantial new supplies of goods and services to global markets. In addition, the more rapid rate of technological innovation, so evident in the United States, has boosted the pace at which our productive potential is expanding. These shifts in aggregate supply, whether foreign or domestic in origin, influence the relationship between money and prices. Moreover, the tie between money and prices can be altered by dysfunctional financial intermediation, as we have witnessed in Japan. Thus, recent experience understandably has stimulated policymakers worldwide to refocus on deflation and its consequences, decades after dismissing it as a possibility so remote that it no longer warranted serious attention. The meaning of deflation and the characteristics that differentiate it from the more usual experience of inflation are subjects being actively studied inside and outside of central banks. As I testified before the Congress last month, the United States is nowhere close to sliding into a pernicious deflation. Moreover, a major objective of the recent heightened level of scrutiny is to ensure that any latent deflationary pressures are appropriately addressed well before they become a problem. Central bankers have long believed that price stability is conducive to achieving maximum sustainable growth. Historically, debilitating risk premiums have tended to rise with both expected inflation and deflation, and they have been minimized during conditions of approximate price stability. Although the American economy has largely escaped any deflation since World War II, there are some well-founded reasons to presume that deflation is more of a threat to economic growth than is inflation. For one, the lower bound on nominal interest rates at zero threatens ever-rising real rates if deflation intensifies. A related consequence is that even if debtors are able to refinance loans at zero nominal interest rates, they may still face high and rising real rates that cause their balance sheets to deteriorate. Another concern about deflation resides in labor markets. Some studies have suggested that nominal wages do not easily adjust downward. If lower price inflation is accompanied by lower average wage inflation, then the prevalence of nominal wages being constrained from falling could increase as price inflation moves toward or below zero. In these circumstances, the effective clearing of labor markets would be inhibited, with the consequence being higher rates of unemployment. Taken together, these considerations suggest that deflation could well be more damaging than inflation to economic growth. While this asymmetry should not be overlooked, several factors limit its significance. In particular, more rapid advances in productivity can make this asymmetry less severe. Fast growth of productivity by buoying expectations of future advances of wages and earnings, and thus aggregate demand, enables real interest rates to be higher than would otherwise be the case without restricting economic growth. Moreover, to the extent that more rapid growth of productivity shows through to faster gains in nominal wages, there will be fewer instances in which nominal wages will be pressured to fall. One also should not overstate the difficulties posed for monetary policy by the zero bound on interest rates and nominal wage inflexibility, even in the absence of faster productivity growth. The expansion of the monetary base can proceed even if overnight rates are driven to their zero lower bound. The Federal Reserve has authority to purchase Treasury securities of any maturity, and indeed already purchases such securities as part of its procedures to keep the overnight rate at its desired level. This authority could be used to lower interest rates at longer maturities. Such accidents have precedent. Between 1942 and 1951, the Federal Reserve put a ceiling on long-term Treasury yields at 2.5%. With respect to potential difficulties in labor markets, results from research remain ambiguous on the extent and persistence of downward rigidity in nominal compensation. Clearly, it would be desirable to avoid deflation, but if deflation were to develop, options for an aggressive monetary policy response are available. Fortunately, the ability of our economy to weather the many shocks inflicted on it since the spring of 2000 attests to our market system's remarkable resilience. That characteristic is far more evident today than 2 or 3 decades ago. There may be numerous causes of this increased resilience. Among them, ongoing efforts to liberalize global trade have added flexibility to many aspects of our economy over time. Furthermore, a quarter century of bipartisan deregulation has significantly reduced inflexibilities in our markets for energy, transportation, communication, and financial services. And of course, the dramatic gains in information technology have markedly improved the ability of businesses to address festering economic imbalances before they inflict significant damage. This improved ability has been further facilitated by the increasing willingness of our workers to embrace innovation more generally. Irrespective of how deflationary forces might influence it, our economy has the benefit of enhanced flexibility, which has, at least to date, allowed us to withstand potentially destabilizing effects of some substantial negative shocks. Certainly, lurking in the background of any evaluation of deflation risks is the concern that those forces could be unleashed by a bursting bubble in asset prices. This connection, real or speculative, raises some interesting questions about the most effective approach to the conduct of monetary policy. If the bursting of an asset bubble creates economic dislocation, then preventing bubbles might seem an attractive goal. But whether incipient bubbles can be detected in real time and whether, once detected, they can be diffused without inadvertently precipitating still greater adverse consequences for the economy remain in doubt. It may be useful as a first step to consider both the economic circumstances most likely to impede the development of bubbles and the circumstances most conducive to their formation. Destabilizing macroeconomic policies and poor economic performance are not likely to provide fertile ground for optimism that usually accompanies surging asset prices. Ironically, low inflation, economic stability, and low risk premiums may provide the tinder for asset price speculation that could be sparked should technological innovations open up new opportunities for profitable investment. Even in such circumstances, bubble pricing is likely to be inhibited for a company with a history. To be sure, stock prices of old-line companies do rise somewhat through arbitrage when the market as a whole is propelled higher by stock prices of cutting-edge technologies. But it is difficult to imagine stock prices of most well-established and seasoned old-line companies surging to wholly unsustainable heights. With some prominent exceptions, their capabilities for future profits have been largely tested and delimited. The situation is likely different in the case of a new company that employs an innovative technology. Under these circumstances, the dispersion of rationally imagined possible future outcomes could be wide. If forecasts are unfettered by a need for consistency with the past, investors might take off on unwarranted flights of optimism. Moreover, skeptics find it too expensive or too risky to short sell the shares of such a company, especially when its stock price is rising rapidly. The conditions of extended low inflation and low risk were combined with breakthrough technologies to produce the bubble of recent years. But do such conditions always produce a bubble? It seems improbable that a surge in innovation in the near future would generate a new bubble of substantial proportions. Investors are likely to be sensitive to the need for asset prices to be backed ultimately by an ongoing stream of earnings. Hence, a further necessary condition for the emergence of a bubble is the passage of sufficient time to erode the traumatic memories of earlier post-bubble experiences. Most standard macroeconomic models fitted to the experience of recent decades imply that a distortion in valuation ratios induced by a bubble can be offset by adopting a sufficiently restrictive monetary policy. According to such models, a tighter monetary policy on average credibly constrains demand and lowers asset prices, all else being equal. These models can also be interpreted to suggest that incremental monetary tightening can gradually deflate stock prices. But that conclusion is a consequence of the model's construction. It is not based on evidence drawn from history. In fact, history indicates that bubbles tend to deflate not gradually and linearly, but suddenly, unpredictably, and often violently. In addition, the degree of monetary tightening that would be required to contain or offset a bubble of any substantial dimension appears to be so great as to risk an unacceptable amount of collateral damage to the wider economy. The evidence of recent years, as well as the events of the late 1920s, casts doubt on the proposition that bubbles can be diffused gradually. As I related this summer at the annual Jackson Hole Symposium, sponsored by the Kansas City Federal Reserve Bank, our experience over the past 15 years suggests that monetary tightening that deflates stock prices without depressing economic activity has often been associated with subsequent increases in the level of stock prices. Such data suggest that nothing short of a sharp increase in short-term rates that engenders a significant economic retrenchment is sufficient to check a nascent bubble. The notion that a well-timed incremental tightening could have been calibrated to prevent the late 1990s bubble is almost surely an illusion. In short, unless a model can be specified to capture the apparent market tendency toward bidding stock prices higher in response to monetary policies aimed at maintaining macroeconomic stability, the accompanying forecasts will belie recent experience. Faced with this uncertainty, the Federal Reserve has focused on policies that would, as I testified before the Congress in 1999, quote, mitigate the fallout of an asset bubble when it occurs and hopefully ease the transition to the next expansion, close quote. The Federal Open Market Committee chose, as you know, to embark on an aggressive course of monetary easing 2 years ago, once it became apparent that a variety of forces, including importantly the slump in household wealth that resulted from the decline in stock prices, were restraining inflation pressures and economic activity. It is too soon to judge the final outcome of the strategy that we adopted. The contractionary impulse from the decline in equity prices appeared to be diminishing around the middle of this year. But then the fallout for stock prices from corporate governance malfeasance, argued by some as having been spawned by the bubble, became more intense. This in turn damped capital investment and trimmed inventory plans. More recently, of course, geopolitical risk has risen markedly, further weighing on demand. Though unrelated to the bubble burst of 2000, it has muddied the evaluation of the post-bubble economy. If the post-mortem of recent monetary policy shows that the results of addressing the bubble only after it bursts are unsatisfactory, we would be left with less appealing choices for the future. In that case, finding ways to identify bubbles and to contain their progress would be desirable, though history cautions that prospects for success appear slim. The difficulties that policymakers and private agents face become especially acute as an economic expansion lengthens. The decline in risk premiums under these circumstances presumably results in part from rational appraisals. In an economy in which the business cycle has averaged 4 years in length over a protracted period, households and businesses would doubtless become more cautious in the 4th year of a new cycle. But how do we behave when, as for the past 2 decades, expansions have been long and cyclical downturns have been exceptionally rare? After 5 or 6 years of uninterrupted expansion, is it irrational or even unreasonable to assume that expansion would continue for the subsequent 6 months? Thus, it was disturbing to observe risk seemingly being priced so cheaply in late 1997 when BBB corporate spreads over 10-year treasuries sunk to only 70 basis points. That spread is now about 250 basis points, although it has narrowed significantly in recent weeks. Weaving a monetary policy path through the thickets of bubbles and deflations and their possible aftermath is not something with which modern central bankers have had much experience. As I noted earlier, it seems ironic that a monetary policy that is successful in inducing stability may inadvertently be sowing the seeds of instability associated with asset bubbles. I trust that the use by the central bank of deliberately inflationary policy as protection against bubbles can be readily dismissed. While the current episode has not yet concluded, it appears that responding vigorously in a relatively flexible economy to the aftermath of bubbles, as traumatic as that may be, is less inhibiting to long-term growth than chronic high inflation monetary policy. modern inflation might possibly inhibit bubbles, though at some cost of reduced economic efficiency. However, I doubt that such policies could be sustained or well controlled by central banks. Among our realistically limited alternatives, dealing aggressively with the aftermath of a bubble appears to be the most likely to avert long-term damage to the economy. Regardless of history's verdict on a policy that addresses only the aftermath of bubbles, we still need to improve our understanding of the dynamics of bubbles and deflation to contain the latter, if not the former. Before closing this evening, I would like to take a few minutes to address recent economic developments. As I pointed out earlier, the U.S. economy exhibited considerable resilience to a series of post-boom shocks. The list is rather impressive. First, a halving of stock prices and household equity wealth. Second, a dramatic decline in capital expenditures. Third, the tragic events of September the 11th. Fourth, the disturbing evidence of corporate malfeasance. And fifth, the recent escalation of geopolitical risks. I would scarcely state that our economy was not shaken by these series of shocks, one on top of the other. But after we experienced a mild recession, real GDP grew in excess of 3% over the year ending in the third quarter. The recovery, however, ran into resistance in the summer, apparently as a consequence of a renewed weakening in equity prices, further revelations of corporate malfeasance, and then the heightened geopolitical risks. Concern on our part led the Federal Open Market Committee to reduce its targeted federal funds rate 50 basis points at our early November meeting as some insurance against the possibility that the weakening would gain some footing. Although our most probable forecast already was that growth would pick up, we judged the cost of the insurance provided by additional easing as exceptionally modest because we viewed the risk of an imminent rise in inflation as remote. The limited evidence since the November easing has supported our view that the U.S. economy has been working its way through a soft patch. And the patch has certainly been soft. The labor market has remained subdued as businesses apparently have been reluctant to add to payrolls. The manufacturing sector remains especially damped, and non-residential construction has trended lower. By all reports, state and local governments continue to struggle with deterioration in their fiscal conditions. Oil prices have recently risen, and not least, the economies of most of our major trading partners have shown little vigor. Still, low interest rates and rapid advances in productivity have been providing considerable support to economic activity. Those influences have been most evident on consumer spending and new home sales, which have been remarkably firm this year. Motor vehicle sales have been supported by low financing costs, by high levels of customer incentives, and by high rates of vehicle scrappage and multiple car ownership. More broadly, strong growth of labor productivity supplemented by reduced tax payments has provided a boost both to incomes and to spending. Meanwhile, new home sales have been buoyed by low mortgage interest rates as well as favorable demographics. Cash borrowed in the process of mortgage refinancing, an important support for consumer outlays this past year, is bound to contract at some point, as average interest rates on households' total mortgage portfolio converges to interest rates on new mortgages. However, applications for refinancing, while off their peaks, remain high. Moreover, simply processing the backlog of earlier applications will take some time, and this factor alone suggests continued significant refinancing originations and cash outs into the early months of 2003. Corporate risk-taking underwent pronounced retrenchment following the traumatic disclosures of corporate malfeasance this summer. Capital appropriations slowed noticeably across a broad spectrum of American industries. Aggressive accounting practices seemingly disappeared virtually overnight. I would not be surprised if further disclosures of questionable practices were to surface in the months ahead, but I would be quite surprised if such practices were introduced after mid-2002. Since early October, conditions in financial markets have turned less adverse. Stock prices have on net moved up, and corporate yield spreads, especially for below investment-grade debt instruments, have narrowed significantly. Those spreads nevertheless remain quite elevated relative to their readings of early 2000. Credit derivative default swaps have improved recently in line with yield spreads. The overall cost of business capital has clearly declined, inducing in recent weeks increased issuance of bonds of all grades and halting the runoff of commercial paper and business bank loans. The recent increase in the expansion of business credit may hint at some stirring in capital investment, but it is simply too early to tell. There is evidence that some corporate managers are beginning to tentatively venture out on the risk scale. New orders for capital goods, equipment, and software, after falling sharply over the preceding 2 years, have stabilized and in some cases turned up in nominal terms this year, an improvement to be sure, but not necessarily the beginnings of a vigorous recovery. In the end, capital investment will be most dependent on the outlook for profits and the resolution of the uncertainty surrounding the business outlook and the geopolitical situation. These considerations at present impose a rather formidable barrier to new investment. Profit margins have been running a little higher this year than last, aided importantly by strong growth in labor productivity. But a lack of pricing power remains evident for most corporations. A more vigorous and broad-based pickup in capital spending will almost surely require further gains in corporate profits and cash flows. A full enumeration of the caveats surrounding the economic outlook would, as usual, be lengthy, but often cited concerns about the levels of debt and debt servicing costs of households and firms appear a bit stretched. The combination of household mortgage and consumer debt as a share of disposable income has moved up to a historically high level. But the upward trend in the series reflects in part financial innovations that have increased access to credit markets for many households. These innovations include the development of a deep secondary market for home mortgages, along with the advent of credit scoring and automated underwriting models that have enhanced the ability of loan officers and credit card companies to identify good credit risks. These innovations lower the risk level of any given amount of debt. To be sure, the mortgage debt of homeowners relative to their income is high by historical norms. But as a consequence of low interest rates, the servicing requirements of that debt relative to homeowners' income is roughly in line with the historical average. Moreover, owing to continued large gains in residential real estate values, equity in homes has continued to rise despite very large debt finance extractions. Adding in the fixed costs associated with other financial obligations such as rental payments of tenants, consumer installment credit, and auto leases, the total servicing costs faced by households relative to their income appears somewhat elevated compared with longer-run averages, but arguably they are not a significant cause for concern. Some strain from corporate debt burdens became evident as rates of return on capital projects financed with debt fell short of expectations over the past several years. While overall debt has not been paid down, corporations have significantly increased holdings of cash and have reduced their near-term debt obligations by issuing bonds to pay down commercial paper and bank loans. In early 2000, as financial imbalances and increased risk brought the surge in capital investment to an end, significant profitable opportunities remain to be exploited. One must presume that they still exist and may well have been enlarged by subsequent technological advances. Indeed, one of the most remarkable features of the performance of the U.S. economy over the past year have been the extraordinary gains in productivity. The increase in output per hour over the year ending in the third quarter, 5.5%, was the largest increase in several decades. That pace will not likely be sustained, but it suggests that the underlying supports to productivity growth have not yet fully played out. Against that background, any significant fall in the current geopolitical and other risks should noticeably improve capital outlays, the indispensable spur to a path of increased economic growth. In summary, as we focus on the dangers of bubbles, deflation, and excess capacity, the marked improvement in the degree of flexibility and resilience exhibited by our economy in recent years should afford us considerable comfort for now. Still, economic policymakers are having to grapple with what seems to be a much larger portfolio of problems than that which our predecessors appeared to face a half-century ago. The ever-growing complexity of our global economic and financial system surely plays a role. Moreover, the very technologies that have helped to reap enormous efficiencies have also presented us with new challenges by increasing our interconnectedness. I venture that future invitees to the Economic Club of New York dinners will not lack interesting problems to address. Thank you very much. I look forward to your questions.
Thank you, Mr. Chairman. Thank you very much, Mr. Chairman. Ladies and gentlemen, our questioners this evening are Edward S. Hyman, Chairman, International Strategy and Investment Group, and Henry Kaufman, President, Henry Kaufman and Company. We'll begin with Ed, if you will.
Mr. Chairman, thank you for your informative remarks.
There you are. Hi, Ed.
And I'd like to join Dick and Henry and the group here in wishing you in particular a happy and safe holidays.
Thank you very much, and same to you.
My first question is, given low utilization rates and the rapid productivity growth we've seen and the low growth rates in Europe and Japan, should U.S. policymakers be shooting for a couple of years of 5 or 6% growth? And if so, should tax cuts be aimed at consumer spending or capital spending?
How many questions was that, Ed?
Ray gave me 3.
Let me just say first that it is certainly the case that capital investment, as I indicated before, is low, and capacity utilization is itself at somewhat lower levels than typically one would see in following as mild a recession as we had. And if indeed capacity expansion were the sole means by which capital investment could be created, then yes, we would need very significant growth rates in which to get the capital investment going, which in turn would galvanize consumers and the rest of the economy and move it forward. However, when we are dealing with the types of potential new technologies with which we're all aware, a very substantial part of those technologies are not for the expansion of capacity per se, as you well know, but largely to reduce costs, and indeed they've been doing a remarkable job at doing that. And hence you can have a very substantial amount of capital investment without very much in the way of capacity expansion. I don't deny that even though when you're directing capital investment at cost reduction, you almost invariably increase capacity, but the mere existence of the overhang in and of itself, if the geopolitical risks fall and the general uncertainties which have characterized the fallout from the corporate governance scandals is reduced, I think we've got a fairly substantial amount of unexploited investment out there. Should we, as you put it, have economic policies directed at 5 or 6% growth? Well, if we could figure out how to do that, I'd love it. The truth of the matter is you just don't have, as a policy question, a goal of growth, because remember that growth is largely, or I should say the GDP growth rate, as you well know as well as anybody, is the sum of the increase in the civilian labor force plus the change in productivity. And it's not clear to me that we as policymakers can, unless we're going to increase immigration by a very substantial amount, or find economic tools in which why government, by turning a dial, can increase productivity, we're not going to get to 5 or 6% growth. 5 and 6% growth, if it happens, is going to come out of the private sector. Believe me, we are not going to have very much to do with it. And if it happens on our watch, I'd love it. But I'd scarcely want to take the credit for it. And maybe I'll come back to that very last question about the impact on consumption and the like as part of an answer to another question.
Mr. Chairman, I'd like to come back to your very interesting remarks about the bubble. Are you saying tonight that bubbling is not a monetary phenomenon? Are you saying that the monetary policy role has nothing to do with a bubbling? And in any event, is there any role to play when you have to deal with a bubble for moral suasion, considering the high standing that the monetary authorities do have throughout the world?
Well, no, in fact, I thought I said that somewhat perversely that bad monetary policy, inflationary monetary policy, will assure that bubbles will not arise. So had we wished to have as our major goal, or more exactly our sole goal, not to allow bubbles to arise, I can assure you we know how to do that. But I wouldn't recommend it as a policy. The irony is it may very well be that a necessary condition for bubbles is, as I mentioned in my prepared remarks, a degree of stability in the economy, which in the modern world is generally engendered by a successful monetary policy. So the issue here is that we have an extraordinary problem where success has the capability, because it induces and opens up states of euphoria, creating significant problems. No, monetary policy is crucially involved in the issue of bubbles on both sides. On the issue of moral suasion, as I think we've discussed before, moral suasion, incidentally, is the, I don't know, how would you say it, the instruction given by policymakers to the society about what they should or should not be doing, I guess. I find that exceptionally unuseful unless you follow it up with real action. In other words, I've been through many experiences over these last 15 years when I've expressed my view about relative values here or there, and everyone knew that we couldn't do anything about them and was completely disregarded. I do not believe that public officials can talk down markets or talk them up or change markets' perceptions. I've never seen a case of it, but never having seen a case has in no way diminished the pressures that we get to use, quote, our moral authority to attack the issue of irrational actions in markets, to do things which basically we know we are not going to follow up with any specific action. If I were to get out and say, during, let's say, one of these speculative booms, this is a terrible thing, eventually it will go down, the market will collapse or something like that, I doubt if anything will happen. If I go out and I say, if this continues, the Federal Open Market Committee is going to raise interest rates by 600 basis points, something will happen. But it is not the evaluation of policymakers. I think it's, unless you back it up, Henry, with action, I don't think we got anything. I don't think we have anything.
Ed?
Thank you. Mr. Chairman, I agree with your remarks that I've seen that we're not in a housing bubble. But my question is this. In retrospect, what can we learn about monetary policy from the stock market bubble that might be relevant if a housing bubble begins to develop?
Well, one usually doesn't answer hypothetical examples as a federal official, so I will make believe. I will make believe I'm back in the private sector when I used to answer such questions, as you may remember. Maybe not. Look, bubbles of any nature are really historically representations of a peculiar state of human psychology. What is extraordinary about them is that irrespective of the time and place, they all have incredibly the same characteristics, which, for want of a better term, are exhibitions of human greed going wild and hope over experience of any type. That will be true whether it was tulip mania, whether it was a South Sea bubble, whether or not it's a housing bubble, whether or not it's a stock market bubble. So if you're saying, what do we learn? I say, we learn lots every time we have a bubble, but what we tend to learn is that what we believed in the past was accurate.
I'd like to come back to the interesting remarks you made about deflation. If at some time in the future, U.S. monetary policy has to combat deflation, would it be preferable to initiate these monetary countermeasures when the inflation rate is still slightly positive, or when the tilt towards inflation becomes much more noticeable?
Henry, it depends whether or not we know when the inflation rate is still positive that it's going down. Obviously, if we were certain of that, then yes. Obviously, one would tend to move ahead of the curve, and indeed, when, on those rare occasions, we do have some sense of where the markets are going, we do move ahead of the curve. But that's exceptionally difficult to do. I mean, take the current period. We had, as you well know, a very significant decline in the rate of inflation, and especially a decline, which is the more important issue in a way, expected inflation, and hence the expected inflation rate embodied in long-term interest rates. That came down and it stopped for all practical purposes. In other words, we did not, the rate of decline from disinflation stabilized, and while we are still in a low area, it's not at this particular stage obvious that we're tilting downward. So how, I mean, today is a sort of an obvious case test of this particular type of thesis. Were we sure that inflation would continue down and turn into deflation, yes, we would probably move. But from everything we see, I mean, all of the monitoring we do in all of the markets, both here and abroad, excluding Japan, does not confirm that. It may, but it hasn't yet. And indeed, the fact that it has stabilized at a fairly low inflation rate or low inflation expectations suggests that the longer it goes on, it will not. But obviously, one of the reasons why we took the insurance out in the funds market back in November was that there was a small possibility that weakness might accumulate and continue down. And as I said in my prepared remarks, because the cost of moving 50 basis points was so low, I mean, the insurance cost was so low that it was worthwhile doing it. Now, if in a certain sense, what we were doing is what you are suggesting. It was not, however, because we believed that there was significant and mounting evidence that deflation was coming upon us. There has not been such evidence. We are extraordinarily sensitive to the issue, however, because having never faced it before, we are looking at it in a way far more intensely than we look at inflation, which we've experienced on many occasions and we know what we're looking at. So we're trying to learn a very considerable amount about how this process works and trying simultaneously to run a monetary policy when our database is so thin. But we cannot, and I don't believe anybody can, reasonably well project when you are moving from a period of low inflation into deflation. If we could find a way to forecast that in some very successful way, then of course we would move in advance. And indeed, even when we suspect and don't know for sure, we do tend to essentially move in part towards, we tact towards a certain type of goal. I don't think we will ever reach a point where we will be able to forecast in a manner sufficiently successfully to be able to do the type of monetary policy that you are suggesting. But we're still looking and we're still learning, and maybe we're going to learn a great deal out of this current experience.
Mr. Chairman, my next question is about China. As we all know, China's economy is big and it's growing rapidly. I saw that it's the world's fourth largest auto market, and it's up 50%. China is also experiencing price declines or deflation. And the question is, should we view China as a deflationary machine or as an engine for growth for the world economy?
China has really managed an extraordinary change from some of its earlier history in the 40s and in the 50s and 60s. And there is a wonderful degree of capitalist dynamic that we see in this communist state, which many capitalist states envy. And they are changing. They are gradually, as you well know, introducing property rights, introducing markets, all of the infrastructure that is so critically necessary for the functioning of these markets. But having said that, it is true that they are a very large economy, but remember that a very substantial part of their GDP is implicit in the fact that they have to feed and clothe and house 1.3 billion people. You have no idea how much GDP that is. So when people say, well, how do we know that the Chinese GDP is anywhere near what they say it is? I say it's very simple. If you know that there are 1.3 billion people and they are alive, there is of necessity a very large part of a GDP that is involved. You have to subtract that subsistence GDP from the total to get a sense of the size of the economy as it enters into the international market. And that number, while growing very rapidly, is not even remotely of an order of magnitude which has a significant impact. So that the argument that you often hear that the Chinese are exporting deflation to the rest of the world is frankly a rather large exaggeration. I hope that they continue to expand. I hope they continue to move. I hope they continue to trade. Obviously, joining the World Trade Organization was a seminal event for them. It's induced a whole series of actions which I think has clearly contributed to the functioning of their economy, and indeed, to the extent that they prosper, it helps us. The more trade, as I implied in my prepared remarks, the better everyone else is. So I expect them to continue to do what they're doing, and I trust that they are able to maintain the tradition of Zhuangzi, who is such a critical force in this whole major change in the largest populated country in the world.
Ladies and gentlemen, a round of applause for our two expert questioners, Henry Kaufman and Ed Hyman. Mr. Chairman, we are so very fortunate that you serve and continue to serve our nation with such incredible skill. I want to thank you on behalf of the trustees of the club for this, your 7th appearance. The chairman has asked that I assure you that if you appear, those who are here tonight, if you are present at his presentations 8, 9, 10, 11, and 12, which will be scheduled, you will have perfect clarity as to where the Fed is going. On that note, ladies and gentlemen, thank you so very much. God bless you. God bless America.
Today, Senator Trent Lott of Mississippi announced that he will be stepping down from his position as Republican leader, issuing this statement, saying,